This is not a political broadcast. We're not here to argue who you voted for, who's ruined what, who thinks Rachel shouldn't be ever allowed near a calculator, or indeed whether she ever knows what one is. The idea, in principle, is politics-free zone. So you're safe, we're safe, and we're going to kind of try and do our best. The reality is we're all here today to help businesses kind of make sense of what landed in this year's budget, what it actually means commercially to us all, and what we as business owners can realistically do about it. So there's no drama, no hysteria, just get straight in with a bit of clarity. So as you know, we understand that whilst the burdens placed upon us may not be our fault and our position, they are our responsibility to do something about this. And what we're going to try and do is work out how we share that responsibility together. There's been a lot of noise. There's been 40-odd tax rises. Some of them are headline grabbers. Personally, if I hear the word smorgasbord once more time, I'll be a little bit bemused, to say the least. And I think also, if you've listened to some of the press, you think half the world or half the UK has moved to Dubai and ran our shores. Now, genuinely, that's right for some people, and it is the right strategy. And to be fair, if you're curious about that, we're actually going to be doing a podcast in January just on that topic, because we want to talk about how people are moving themselves and their businesses, how we've helped and supported people in doing that. But I think, let's be honest, it's not really there for everybody. It's not the right thing. I love the sunshine as much as anybody else, but I like the UK countryside. You know, I've got a lot of my family and friends here, and while some of them would be glad to see the back of me, I think it's about what can we do from this budget here in the UK. I think many of us don't actually want to run away. We want that clarity. We want to know what's changed. And I think we want to know how we're going to navigate through this ourselves, how we're going to look after ourselves, our families, our businesses, and our colleagues. And for me, that's really where the resilience piece comes in. We talk about British business owners and what have you, but ultimately, how do we get on with this despite how hard these times are? And I think the theory is today, by the end of this session, we're going to feel stronger, and we're going to see how we can use that resilience wisely. So, quick bit of introductions for people who haven't joined us before. Those who don't know me, I'm Martin. I'm the CEO of the White Label Resources Group. Personally, I have the privilege of leading an absolutely tremendous organisation with professionals right across the board. We're able to build on our growth organically, and we are working through acquisitions. Most recently, a fabulous acquisition in the Southwest, Tamar Accountancy. And our job is to bring key professional supports from within our group, those elements of accountancy, law, finance, insurance, under one support mechanism, supporting businesses. So it kind of makes it a bit easier instead of chasing down multiple advisors, giving them multiple stories. We're here to bring it under a single solution. So joining me today are two people that you may recognise faces of, and the endeavour is to keep this vaguely respectable. Alex Reynolds, our head of tax, accountancy and advisory. So he's a guy who actually understands the numbers genuinely, as opposed to pretending like I do. And Mike Ball, our chief commercial officer across group, who with Alex and the team of advisor, translates those details into strategies that business owners can genuinely use, understand, and drive the businesses forward. So today we're going to kind of keep this practical. We're going to break it up into a couple of areas. We're going to talk about business taxes, what's changed, what it means for businesses, and where those planning windows are going to be. We'll have a chat into personal tax, in particular inheritance tax, because although nothing new really came out this year, the damage was done last year. Yep. And that's hitting us properly this coming April. Property landlords, once again, scourge of the universe. Property landlords have had it another short straw, a bit of a hard hitting. So if you are using property as maybe a long-term play, and we want to understand more in our strategies, we're gonna have a bit of a dive into that. And then we're going to try and stitch it all together, work out what this means for us strategically, and how we can stay in control rather than just reacting to these tax pieces. We're also going to take some questions at the end. We've got Jasmine and Weird Wolf here on standby to help us work through this. So if anything pops up during the chat, please do get those on. We'll deal with those towards the end. So What I do want to say as we start this is genuinely some of the biggest opportunities for us to move our businesses forward are going to be coming over the next few months, the planning window between now and April 2026. So as well as dissecting some key points in this budget, let's keep that in the forefront of our mind. A lot of this is from last year's budget. So we dig into gifts from surplus income, sales versus gifts, capital income extraction, corporate restructuring, MBOs, holding companies. These are the kind of things that get banded around a lot, but it's really important we understand these aren't niche tools. These aren't just for the big international corporates. These are genuine opportunities and strategies that we can use commercially for our businesses. It's about having the right knowledge, the right advice around you. They might just be for you. Those are for such a more powerful reason than many people realise, and that's what we're going to be looking at. So we're not here to terrify you. We're going to try and keep it quite light. As you can see, our own tools for how we got through this year's budget are available and on hand. So we're going to have some conversation now, but with a key message. If you understand the facts and you use the right structure, you're going to be all right. Our job is to help on this through this piece. Let's deal with the facts, let's spot the opportunities, and let's give all of us business owners enough clarity to go into 2026, our eyes wide open rather than our heads in our hands. All right, enough from me. Let's get things started. Let's look at the first piece of it, Alex, the budget, the tax rises that matter and what it means for us. We're going to let you pick the stand from here.
Oh, thanks. Well, thanks, Martin. Thanks for your introduction, and used your 10 minutes wisely.
We try.
But so first of all, I just want to look at the impact on your business of the tax rises. I'm not going to go through all 40 tax rises, and we've kind of picked a few, and then we've got a few that were just general updates on things that were already in place, and things that have slightly been tweaked, and things that have changed. From a business point of view, I think from the profit extraction angle, the most obvious headline is the 2% increase in dividend tax, which is going to happen in April 26. Mm-hmm. So that will come in then. There also, we haven't touched any corporation tax rate rises or anything like that. But what this does again is puts it back into the spotlight. What's better, dividend versus salary? Yeah. And again, it's something that we look at with all our clients. And we look on a case-by-case basis, but again, it brings into question that dividend versus salary, and everyone always says, well, what's the answer? And the answer is, it's per individual company and kind of what their tax structure is.
So that's kind of straying away from what's been some people's typical advice and actually going, doesn't make that advice wrong, but it's about understanding it for whatever your individual circumstances are.
Yeah. And again, when that gap comes closer between the salary and the dividend, again, what me and Mike do look at again, what's the best way to extract capital from our business? Is it using all our income tax allowances, but then looking around, is there any opportunities using capital from the business and potentially restructuring and things like that to extract more money out of the business at the best rates?
And look, that's what it's all about, right? Mm-hmm. It's about, of course, we know how to run our businesses, because if we're doing whatever trade we're doing, whatever service we're doing, that's our strength. This is about, okay, well, how do we get that performing for us best in our own needs, in our own commercial positions, and our families' needs and wants?
And excuse me. So we've got a little planning window now. Mm-hmm. So we're in the current regime. There was no significant changes, not like last time where it happened at midnight. So we've got a gap now, potentially up until April, where in April the business asset disposal relief, so that's used to be the old entrepreneurs relief, where it's 10%. You had 10 million at 10%. Last time it's been reduced down to £1 million. It went to 10% change to 14% this year. It's 18% next year. So again, if we're looking at family restructures, bringing in children into the ownership of the business, or we've got an opportunity between now and then to look at yes, let's get our profit extraction numbers correct, salary versus dividend, all that. Let's set it up properly for next year. But also, is there an opportunity between now and then to actually take some capital out of the business using the 14%? It will be 18% next year.
Yeah. Yeah, absolutely. And I guess that's, for me, is one of the angles that we've got to think about is what's already baked in from last year, what's coming for us, and how we're going to hit it. I get, Mike, it's interesting, and what you can't see off camera is down here, Mike's got one of his many drawing apparatus, we'll call it, and you kind of...
It's just so I can get high on the show.
You're enjoying that, aren't you? and I think it's really useful for us to understand how, in real terms, real life scenarios, these sorts of things affect. And I think that's one of the conversations, obviously, we have with customers and colleagues all the time, but you've had quite a lot of phone calls over the last 48 hours, sort of bouncing that about a bit.
Yeah, I mean, look, we say all the time, don't we? It's about structure, and it's about looking at the entire tree, not just the trunk of the tree. And I think normally when you're looking at, say, sort of dividends versus salary, you might be looking at the business owner or the business owner's wife, probably from the day dot, but certainly more so in the last 12 months, you've had to look at the entire picture. And that's what a lot of people forget. So, at a high level, we're always looking at when we're starting new companies or new trades, do we involve, if it was us, do we involve parents in that? What's the family structure? What are the children? Because there's so many opportunities across the piece to spread that income legitimately and save a lot of tax, to the extent that the 2%, really doesn't impact very much. We've effectively gone, for the first 50 grand, we've gone from 8-ish% to 10-ish%, which I think we'd all take, right? But to achieve that, you need to structure things correctly. Yep. And there's a lot of opportunities across the piece, which we can dig into if people want to know. But yeah, more so than ever, we're looking at the whole picture.
And I was going to say, which comes back down to kind of the message that both me and Mike, when we talk to clients, is good tax planning is all about timing. So we've got time now to do something. Last year when we were speaking after the budget, we had time. Some of the stuff we didn't have time because it already happened at midnight, but we still had time between, I think it was October, wasn't it? End of October and end of March to get structures in place before tax rates had changed. Again, now we've got time. So again, the best thing about tax planning is the timing. Make sure the timing's right, because we can't do things in a time machine.
Yeah, and I think what's interesting, and we were talking about it on the way over here, Alex, was making sure you get it right as well. Because one of the risks, there's two kind of risks here, isn't there? There's that issue with, this is the way we do it, that tax has gone up 2%, that's it. That a very binary sort of approach to it. Or there's the opportunity to go, okay, let's take a deep breath here. Let's look at some of these strategic moves we can make and how we can do it. The problem is in between those two things is, and in the good old days, I would straight on the god of Google and work out something there. Wanting to put a plug in, obviously, to our corporate lawyers within group, but it's also about making sure you get this right, making sure the structure of your business is contractually right, is legally right, you've got your articles right, because you can't dip in and dip out.
Yeah, no, I agree. And one of the things we often come across is things have happened in the past. So someone's done a share, or they've created a holding company, or they've gifted some shares to children, which is fine. But quite often there's bits missing out, so actually doesn't make it actually legally correct. And again, that's why we work with the law team very closely and making sure our structures are correct. There's something that's actually happened in this budget which has gone unnoticed, is the fact that when we do a restructure, we put a holding company in, and we try and help clients expand the groups and do a share exchange. That's pretty vanilla kind of planning. Well, actually HMRC under the radar from the 26th of November for a share exchange, when you go for clearance for HMRC, there are actually rules on what your commercial arguments for doing that have really tightened up. So where people have just gone, I'll just put a holding company and did a share exchange, well, it's pretty risk averse stuff. Well, actually, something that's been around for quite a while is...
It's only risk averse if you do it properly.
Exactly. And so again, just putting in those little barriers, just chipping away at everything, chipping away at the dividends, chipping away at this, and now something that's reasonably... vanilla restructuring. It's not even part of tax payment. It's just restructuring to make sure your structure's right. Is now making it a little bit more difficult. So,
and I think for me, that's something that really stands out. Is and we're not political on this, of course. It's really difficult, isn't it? I have to be fair. But it is those things that will trip you up. And you know, there has been for some time with HMRC. Let's bridge it across a couple of governments and a couple of parliaments. There has been some time with HMRC. Their aggressive, their nudge letters, their approaches to doing things to put fear. It feels like now there's an extension that just says, well, just be careful. We know more than you think we know. And I think that's really important that we get that right, because what we're talking about here is how to use legislation correctly, not trying to bend rules, not trying to create bizarre film strategies and go and sit next to Jimmy Carr and half a take that. What we're talking about is using the legislation correctly, but making sure you've got all the boxes right, all the I's and T's dotted and crossed.
I think for a long time, you know, we speak about the frustration that the tax rules apply to everyone. You know, whether you're a 7 billion turnover European group or you're your little sort of manufacturer on the south coast or whatever, and our frustration is that sort of knowledge is power. And you don't need to be scared of implementing things that are actually quite vanilla. It's just, you know, you've got to have the experience of doing it.
And people only know what they know, don't they? Whether that's advisors as well as business owners. So I guess from a business point of view, there's a bit of a message here. There's right structure, right timing, and right tax regime.
As well, just on the business, there's a few things that have admin things that have slightly changed as well. So we talk about the big picture, but also there's the little things that make a difference, not just to business owners, but the employees and things like that. So a few little changes on with PAYE, so the tax-free employer provided benefits are slightly widened, including eye tests and some home working equipment and vaccinations. Again, if anyone's got any questions about that, then just send us an email or we'll follow it. We can follow up questions afterwards. And something that we've been talking about for a little while, which everyone loves, is P11Ds. Was expecting them to be payroll benefits, to be payrolled going forward. That's now been pushed back to 2027, so we'll have to go in P11Ds. Just another admin.
Just more aggravation.
So there are a few little admin-y things I just wanted to.
I think you guys signed off the document last night, so it's just being produced by Weird Wolf, and we'll have our usual budget briefing out that will give all the details and piece on that. So that'll be sent out. But as Alex says, please do sort of make contact and raise any questions. So, okay, let's have a little look about the personal side of things. I think, you know, there's a big thing here on inheritance tax. I do want to remind ourselves it feels like there wasn't major announcements in this year's budget. The damage was done last year. Let's not kid ourselves here. That's pretty significant. So can you give us a bit of a clean and simple version, Alex, of what we look like today, and also probably what we look like in April?
And not just April 26th and April 27th as well. So one of the big things last time was agricultural property relief and business property relief. So previously, you know, for all the years I've been an accountant, I won't say that on public record, but quite a while. Your business, your farm was always outside of your estate for inheritance tax. Last time, there's a £1 million cap on those. That comes into force from April 26. So effectively, if you die after April 26, your farming assets, your business asset are brought into your estate for IHT. That's taxable at 20%, not the 4%. It's taxable at 20% over £1 million. Again, we've worked with a lot of clients over the last 12 months, restructuring, putting things in the right place, let's say, and trying to limit people's exposure to that. Now there was a little tweak to that in the budget, which again I'm not sure has been a major headline. Was you can actually transfer your allowances to your spouse.
Right. Okay. Is that the £1 million?
So your £1 million kind of rolls over onto your wife, because obviously, which I think was lobbied for by some of the business organisations and non-profits, but you know. The main lobbying was to get rid of that completely. Obviously, the Labour aren't going to do that. But, you know, that's now rolled out, similar to what you have with your house on inheritance tax. You're allowed to roll over with your spouse. So there's two things there. One is obviously make sure everything's structured right and correctly, but also if you're not married, not trying to force people to get married here, but just something to bear in mind that, again, talking about allowances and all, your partner could end up with a tax bill on your farming assets or business assets that not necessarily needed. So that's one little tweak. And nothing changed with the nil rate band. It's still 325. Your residence band is still 175. So you've got 500,000 again, which you can roll over. So no changes on that. The other big thing that will be coming in 27 is any unused pension pots will form part of your estate for inheritance tax as well. So again, obviously we don't give financial advice. We can't give financial advice, but we do work with financial advisors very closely. It's again looking at what's the strategy on drawing down when I'm entering my retirement age. What assets do I use? What do I use for my retirement?
Yeah, which is quite interesting. He's trying to loop that lot together again, Mike. Moving that into strategically.
Well,
how we get that benefit.
You've got to think, and I will say, in 30 years, as advisors in our arena, we've spent certainly I've spent 30 years trying to create a trading group for people. Right. That's ultimately you want a trading group because that effectively, inheritance tax always used to be a voluntary tax if you structure things correctly. So we've not had to advise, as long as you've got a trading group on IHT for a long time, and then suddenly we have to. So again, looking back and looking forward, looking at structure, a lot of clients, it's probably the most generous gifting month ever. Last October 24. Yeah, and then we're checking clients have got all those bits of paperwork in place for shifting through the generations. So lots going on now that we've never had to do before. So it's there are solutions. And there are still solutions. We've got until April, but we're having to do things that we've never done. So it's about action. It's about having a conversation.
One of the things you were saying to me yesterday was, I think you'd had a conversation with someone, and it was a real clear message. And it's a good message for us all to take. Just get it all out on the table. Tell me exactly what you've got, what you haven't got, what you think you've got, what does it look like, and then we'll take it from there. Because, as you say, what we may have been advised strategically before, what we may have looked at as individuals before, that's all out the window to a certain degree. And we can't make just quick, sharp, small hits. Let's look at it properly. So actually, don't think the way we've done it is still, even if we think the changes in the budget haven't affected what we're doing, now's the time for a whole piece review. And as chaotic as family lives may be, now's the time to bring in, I think you used the trunk and the tree.
Trunk and the branches, the trees,
let's bring it together.
Because outside of IHT, a lot of what advisors have been trying to do historically is turn an income tax into a capital tax. Because it's so much less. But the IHT position is started to get people to accelerate that sort of planning. So accelerate selling to family, accelerate selling to management teams, gifting earlier. And so, you could be a win-win, ironically. Because, you sell your business, currently you're at 14%, you're at 18% as of next April. So there's still some good tax rates there to benefit from. You've just got to have a conversation about the whole thing.
So it's fair to say, little bit of a reiteration, you're going to be okay. Just need to be okay looking forward, not waiting. All right, Alex, property, the budget equivalent of a pinata. We keep battering landlords left, right and centre. So useful to just break down what it means to us all.
So
if you can do that in 1 minute, mate, that'd be great.
Yeah, great. Yeah, thanks, Martin. So on the property. So again, there was as part of the major headlines: 2% on dividends, 2% on property and savings income. So there's a lot of our clients who've run business for a long time, put money aside in their pensions, got money saved away, got a little property portfolio just ticking over. All of a sudden, we're getting hit by 2% tax on stuff that's that previously was covered by some allowances, and so that 2% comes in April 27. So dividends is 26. property and savings is 27.
Okay.
So just make that differentiation. So I suppose the other thing on for landlords as well is making tax digital. So any portfolio, personal portfolio or partnership that's over £50,000, they're from April 26 have to do make tax digital, which is effectively filing quarterly returns. Yeah, I'm not going to go into detail on that, but if anyone's got any questions about that,
I think that's quite a useful thing to flag it up for people. Yeah. There's a risk that's under the radar. You need to get ahead of that.
Yeah, so that's for sole traders and for and partnerships, and that includes property as well. So a lot of questions at the moment about what software can I use, etc. So if anyone's got any questions on that, if you email it in to the team and stuff, we can deal with that and help get set up. So again, hitting landlords with legislation, hitting landlords with more reporting into HMRC, hitting landlords with more income tax, and I'm sure they'll be really surprised when rental goes up.
Absolutely, it's a knock-on effect. But
and with property as well, the main question we get, we're talking about structure here. Question: can I incorporate my property portfolio? That's a weekly question. What do I do? I want to buy a property. What should I do with it? Again, try and put them into limited companies. At the moment, we're working with a number of clients who have large individual property portfolios in their own name, whether through partnership or in themselves. There's opportunities where we can actually what's called incorporate that into a limited company with basically no tax. It's got to hit a number of key requirements for HMRC to allow that type of incorporation relief. Now, one of the things, again, that's gone under the radar, which you might not have seen in the headlines, because it's not really a headline unless you're in business, is something called incorporation relief. But a lot of our clients have done over the last 20 to 30 years. You actually have to now put that on your tax return. So from April 26, if you incorporate, you have to effectively put that, and I'm not sure how it's going to be done yet, but effectively you've got to put that on your self-assessment.
So it's not an automation.
So the legislation, the previous legislation says it's an automatic relief. You just apply for it and done. You then can trade in a limited company. Been doing that for since I started ticking banks for my green pen. So that's quite a big change because again, it's gone under the radar. It's an opportunity where HMRC can challenge, and we were talking about it in the car. And I feel that the government are trying to trip people up. So they are putting that incorporation thing in from April 26, seeing who incorporates, puts it on their tax return, and then
you've got the next issue,
because the April 27, 2% is coming, so it's pushing people actually. I don't want to pay another 2% on the property portfolio, so I'll incorporate. It goes on your tax return, and now
there's a challenge that we're looking for it. So, and again, that's interesting, isn't it? Because what we've been talking about is that's about what's traditional may not have changed, but let's take a deep breath here because we need to make sure this is structured right, and the right advice has got to be the right advice. It's not what you should do. You should have a bit of this and do a bit of that. It's actually getting under the bones of it, and I think that's something you've again. We're kind of trying to chat about what people suddenly think over the last few days.
And it's like even when we're talking about it, it's like it's something to panic about. At no point have we ever done in a corporation that doesn't have sort of commercial merit and wouldn't tick the boxes. But again, the presentation sort of puts people off. But you do it right, and it works. It's nothing to panic about. But build it into the bigger picture. So when we've got clients that can incorporate the properties, obviously we can do that. But how have they taken the money out to buy those properties, right? And put the deposit down. If we get the group structure right, and we've got a property company and group, then we're not taking money out to be taxed on to then be able to put it. It's tax free, I guess. Because it's not coming out of group structure. So it's just getting it right in the first place.
And that feels like we talked about a moment ago, doesn't it? Right. Take a deep breath. Let's get it all out on the table here and really understand this. And again, not for quick wins. This has got to be a strategy. And these are strategies that play into our commercial strategies if we want to grow our business, if we want to acquire, if we want to do whatever we want to do. This is running alongside that, I think is fair to say.
And even pushing it to, we've got clients that have got car collections and art collections and investments and all sorts of stuff. There's nothing to panic about looking at that in the round.
Looking at the whole picture.
Yeah.
Yeah.
Because again, why take money out of your group structure to be taxed on it to invest in things when you can quite legitimately structure it correctly and reduce your tax? So So look at everything.
Yeah.
So that was the other one I was talking about as well before we put the camera on was finished holiday lets and potential tourist tax.
Yeah.
So again, that was something that I think not that I read the Sun, but I think I saw it on the Sun where it basically said, "Oh, Labour are going to tax your holidays now."
Yeah.
However, that tourist tax, I think it's called tourist levy or something, is it's got a sign off in the budget, but it's per local government.
Yeah.
So it's up to the local jurisdiction to decide whether.
It felt like that falls into the pointless tax category.
Yeah, well, it's already going to happen in Scotland and Wales, I understand. But it's up to, so you might end up having it in, let's just say, the southwest, but not in the Midlands.
Yeah.
You know, so again, that will be something that becomes clear. I think that can be happening from the end of this month as well. So again, it'll be something we'll just be waiting to hear. But again, that's a question that I got asked this morning by a client. I mean, you were talking about it before this, wasn't we? So
it'll be interesting. Again, if I may, I'm going to be okay. We've got to get this right, though. We've got to get this right. Okay, let's have a little think about this before we get everyone reaching for their stiff drink. I think it's really important, if we strip away the noise, of which there has been a lot of it, and let's be frank, there's been a lot of it for the last 4 months as they've been drip feeding leaks and what have you, which has produced the most chaotic, which is a non-political statement, the most chaotic run-up to a budget that anyone's seen. If we get rid of that, there's been a couple of good solid messages that we really need to understand. First and foremost, this is a tax raising budget. There's no point getting away from that. It might not be the loud one, but and the most obvious of ways, but that's what it is. So it comes down to understanding, as we've talked about, and how we utilise that, but how we structure it correctly. I think that's really key.
Yeah.
We've got these frozen thresholds. We've got all sorts of things that are now. Well, I mean, the frozen are stretching out into the next decade. So there's quite a significant challenge there with us on that. We've got these moves in the higher rates on the dividends. But if we kind of break that down commercially, right, deep breath. There's actually an awful lot of stuff that we can do that makes bigger impacts that mitigate effectively that. So, I think a lot of commentators are calling it a stealth budget, but it's about what we do. I mean, it's not difficult to see why we're all, as business owners, feeling pretty bruised by this. But again, what we need to look at is how we react to this, how we deal with this, how we put some structure in it. And I think really, if we look at these inheritance tax changes that start to land, it's almost a once in a generation shift for businesses. But I think the key for me is it's a once in a generation shift for businesses and families. And that's both impact and opportunity, I think would be fair to say. So whilst we've had these shifts, what we now need to do is look at how we deal with the next steps. Through this conversation, we've had some fairly clear points. Alex, you've given us some really good detail, some things we need to be looking out for. It's about how we then move that into opportunities and into our thinking. It's how we do that. Those takeaways for me: know which taxes are really hitting us, and know which ones we want to hit us. That's really clear. Separate the noise from the decisions we make. As business owners, we have choices. Let's make those choices without the noise that's going around. Use each and every planning window, and in particular, this planning window up to April 2026. They often say no time like the present. There is literally no time like the present. And I think, Mike, some of the conversations you've had leading up to the budget, and we've all had them in questions and what have you, but this is about, it's not resting on our laurels. Let's get on the front foot and let's see what we do things. And let's not forget landlords and savers and side assets. There's lots we can do to accommodate for that. And I think the ISA switch to reducing, all that kind of thing. There's so many of these little pieces in there. This I nearly said the smorgasbord comment, but we've got opportunity here. I guess it'd be useful now, Jasmine. I don't know if you've had some questions come in. Let's thank you very much. That's good. So one of the questions, well, it looks like we've had 3 or 4 questions which kind of link together the point about salaries versus dividends, income tax versus capital gains tax. What do I do? Fix some guys.
I think like I said earlier, with the salaries versus dividend, against on a individual basis, on the size of your company and what other benefits. I mean, if you've got an electric car, so you've got a benefit. So again, it's just about tweaking it just to make sure it just hits that sweet spot, whether salary versus dividends. Again, we always, try and maximise everybody up to the basic rate band first step, and then see where we go from there. Yeah.
So I guess the feedback. Oh, go on, Mike.
I was going to say my thought process on that bigger picture is, so for me, my parents helped me set my first company up. Why would I not give them shares? Always have a holdco to protect yourself, but why would you not have parents in it? As parents get older and their income drops, there's capacity there for them to earn more through dividends. So there's some income at a lower rate, right?
Yeah.
There's even capacity for grandparents to gift into trust, for example, income generating assets like property. I mean, obviously there's a load of parameters that need to be hit, like property, like shares, so dividends can go to children. Bigger picture, if you look
so let's not nail into the binary.
So up to 50k, great, but is that one person or is that 6 people?
Great.
There's a whole gambit of stuff that we can look at.
Okay, brilliant. And I'll just take this one here. Again, there's a couple on it, understandably, around property and landlords. I want to transfer my properties into a limited company. Is it still worth doing?
Yes, it's probably that. So if you've got a reasonable sized portfolio, again, to treat a property portfolio as a trade to get the incorporation relief, it's got to hit a number of tick boxes. So again, we can look at that. It's an individual thing basis. I can't just say you can do that. But if you've got a reasonable sized portfolio, yes, incorporate into a limited company. Why would you do that? One is because of the potential increase in tax. In other words, is you can get full allowance on your mortgage interest. And as well, when we're looking at inheritance tax planning, you want to give some shares. It's easier to give shares than it is properties, because if you've got children, right? Okay, let's split this property in 3, or okay, I've got 3 properties. Let's give one each to a child. Well, that one's worth more than that one, does it? All of a sudden, you've got a problem. Arguments between children. However, it's easy to give everyone 10 shares each. Now, yes, there's certain taxes and things on that, but from a general thing, is it better to have your residential properties in a limited company structure? Yes, is the answer.
Yeah.
Property, it doesn't say whether we're talking resi or we're talking commercial, but consider yields, resi versus commercial. Better for it to be in a corporate, but why not put it into a pension scheme? We are not pension advisors, can't give pension advice. However, your commercial property into a SIP, you're getting in the minute 25% tax relief on that. So the government's actually contributing a quarter of the cost of your property back to you in terms of corporation tax relief. Take that one step further. If it goes into a SAS rather than SIP, a SAS can lend money back. The pension scheme can borrow up to 50% of its assets. So if you've got a £400,000 commercial property in a SAS, half of it can be mortgaged, you're getting 25% tax relief, and money can be lent, again, with the right parameters ticked. You can lend that 50% back to your company. So suddenly your £400,000 commercial property is costing you 100k. So, look at yields, take a step back, as you keep saying, remove yourself from the simplicity of the one decision and give yourself 5.
Yeah. Absolutely. And I think the key message for all of us through this has been, right, it's not those binary questions and answers, and don't get caught up in my mate down the pub said the best thing you can do is put property in a limited company. Look at it individually, but look at it as part of a strategy as well. Let's not make this just quick transactional discussion. Let's make this about strategically how we provide for our business, our families, and future generations.
A good point there is my mate down the pub said, or my mate down the pub did, doesn't mean that's right.
We
discussed earlier about some of the sneakier changes, and people aren't aware, and it can cost you in the long run. The fact it's always sod's law, isn't it? Yeah, that your mate down the pub gets away with it, and you're the one that gets caught.
Gets caught. Absolutely. Absolutely. Well, thank you so much, guys. Before I let you guys out there in the rooms escape, I just probably reiterate, as we mentioned, we're doing some work with lots of customers on offshore. Dubai's mentioned a lot, and the UAE. I happen to know that there's one of my friends on here today who's merry out there sunning himself. So I hope you're having a nice time. I'll let you remain nameless. But it is a thing, and it's really useful for some people. So we will be quite specifically doing a podcast in January to give you all some guidance and advice how we're helping people, avoiding some serious trap falls. Going back to your point on the chat in the pub.
Are we going to do that one in Dubai?
We'll do that one from Dubai. Yeah. I might teams in. I'm not sure. I think you've got tax returns due in January, so I won't be here. But yeah, I think you please do look out for that. If you'd like a conversation beforehand, please jump on a call. Give us a shout. We'll definitely help you out with that. As a group, we have these professional services: legal, accountancy, finance, insurance. We exist exactly in this scenario, to kind of sit between business owners and this sort of budget, looking at how we translate it into not just, I don't want to use the phrase normal language, but usable language, how we can translate it into behaviours and strategies that we can use in our business. And then we'll be in the background doing the really unglamorous work, the restructuring, the remodelling, the refinancing, the planning. So I think that takes us from just surviving as business owners to actually building something and moving it forward. I hope you've enjoyed it, and I hope you found it useful. This is absolutely not about blaming the government for all of their countless, numerous failings. It's not about that. This is absolutely about us as business owners grabbing hold of this situation, the one we're in, and understanding every tool and strategy and tax relief that's available, and then using it for our own individual and personal circumstances. Please do reach out to us. As I say, we'll get the contact details out to everybody. Thank you so much for giving us your time. Appreciate how busy everybody is. So to have you give us a bit of your time, we really appreciate it. We hope you found it useful. Have an absolutely fabulous weekend. Thank you very much. Thank you.